So you've got weaker dollar, potential more spending, potential increase in inflation. There's a whole range of things like that that's on the bullish side.
You've got this raging bull in the mining industry, and we're seeing it across the continent.
We've been getting calls from the sorts of investors that we haven't heard from for many years.
Welcome viewers to our headline investor discussion for one-to-one mining investment Africa Online. Alas, no sunny Cape Town location this year. However, we do have a stellar panel of investors and analysts to share with us what's on the top of their minds as we review the mining sector over the next 45 minutes or so. So I'm joined by Charl Malan, who's portfolio manager at Van Eck, Nivaash Singh, co-head of metals, mining and resources at Nedbank, and John Meyer, who's partner and mining analyst at SP Angel. Gentlemen, a very warm welcome to you, and thanks for taking time to help keep the conversation going throughout this lockdown period again. Getting straight to it then, I want to start on some of the big picture themes, and Charl, perhaps I could start with yourself to get your thoughts on how do you interpret this bullish metals market against a bearish global economic backdrop that we seem to be experiencing this year? What does this mean for actual mining investment as well?
A great question. I mean, as we sit here and talk about this today, it seems that this bullish question marks being asked by a lot more people than just you today. I think there's a couple of things we need to look at. I think, first of all, we got to focus on supply, right? 2020 had a number of big challenges across the supply chain, no matter which commodity you look at, mainly related to COVID, obviously. That had a massive impact on inventories being drawn down, et cetera, and that pushed prices higher than what I guess most people expected could happen. So we had sort of that backdrop, I think, that we need to incorporate into our view, into our answer. Then secondly, I think if we specifically talk about the demand side, I mean, you did have throughout 2020 and towards the end of last year, a lot of talk about more stimulus coming through, specifically here in the United States. That stimulus in the last couple of days is being talked about at least another month before we get another package coming through. So that might be putting some question marks on demand. But the stimulus in itself is creating a whole range of things. It's pushing the dollar weaker, obviously, and that's typically very positive for commodity prices. Money that's for free obviously entices people to spend easier in an environment where, entice people to spend easier, and that obviously is more positive for commodity demand in general. People are expecting inflation to come through, so you've got weaker dollar, potential more spending, potential increase in inflation. There's a whole range of things like that that's on the bullish side for commodities. We've got a new administration in the United States that I think is putting a question mark around all the stuff we just spoke about. And I think, to be honest with you, where we stand now relative to where we stood in October, I think there's a bit of more of a question mark regarding demand than what we had in October, maybe, just because we're not sure about what the new administration is going to do.
Right. Do you think then on commodity prices, it's not a case of how high they can go this year, but more a case of how long we can sort of stay here? You've probably been asked, as you said, the super cycle question at the moment, and everyone's getting excited that this could be a super cycle period. But thinking about some of the points you just raised, is this more a case of an inflection point, perhaps, and it could go either way?
I think it could go either way. I mean, the way I typically think about this, and we are more of an equity investor than a commodity investor, is I much rather be in the equity side than the commodity side at the moment, right? There's massive margin expansion that's taken place. There's cost compression that's taken place. So there's significant cash generation that's occurring. Very little debt in the balance sheets, very little capex growth in generally. So where does the money go to? That's the way I look at it at the moment. I'm not going to stand here and say I think commodity prices go significantly higher, significantly.
Yep. So
lower. I think we're in an environment okay for a while. I think we're in a place where commodity price can be okay for a while. What does okay mean? Up, down 10%, maybe 15%, somewhere around there. But even in that in that frame of, of commodity price projections that I gave you, I think the mining companies are financially strong enough and extremely attractive from a valuation point of view and a yield point of view that makes it exciting investment case. Let me put this out there, and then I'll hand it over to somebody else to add to it. Just think about dividend yields for one quick second, and use PHP, use Rio Tinto, use Anglos, whomever you want to use that pays a dividend, right? So dividend yields 3, 4, 5, 6%, depending on who you're talking to. The S&P dividend yield at the moment is about 1.7, 1.8. So clearly a much more attractive sector than the broad base. And I think that's where the future lies for this company, is to attract a broader investment portfolio. Get the value fund manager, the yield fund manager. That's where I think the focus sits for equities. I don't think so much the question is going to be what's going to happen to commodity prices. I think it's going to be here or there.
Yep, excellent. We'll come on to some of those final points in more detail, I think, later, certainly around the companies and the generalist interest as well. Nivaash, could I turn to you and get your take on this market scenario that we're facing? And what's the view from Nedbank with regards to where we might be in the investment cycle for mining?
Well, thanks. I think it all depends on whose lens you are looking through. Charl described a very interesting dynamic, and that's, from the lens of an equity investor. My lens is very different, and I think the context is critically important. Nedbank is a debt provider, so we are very much upstream. We are the source of financing mining projects on the continent of Africa, and we take a view on commodities as a whole, depending on the category, either it's base metals, precious metals, or industrial minerals. And from where I sit, we see a heavy sort of tilt towards Chinese consumption for downstream beneficiation. And currently, the Nedbank view is that it's an extreme oddity while the rest of the world is in a bear market where you've got negative GDP growth in developed countries like Australia and most countries in Western Europe. You've got this raging bull in the mining industry, and we're seeing it across the continent, not just the South African mining industry, but the continental African mining industry. And for us, it's very simple. We're seeing a surge in demand for commodities, particularly out of China. We don't know what the reason for it is. We think we know. All we can do is connect the dots. And I think a lot has to do with COVID-19 and the second wave of the virus that we're in. There are some protagonists that are predicting a third wave and a further lockdown. Who knows? But I think there's a fair amount of panic buying in the market where downstream processors or beneficiation companies are stockpiling, particularly base metals, for fear of supply disruptions. And we see companies like First Quantum Minerals, as an example, Canadian listed company with quite a large investment in Zambia and the copper space. They are investing a further $1 billion in Zambia to kind of build out their copper production. So we think it's an extreme oddity that I certainly haven't seen in my career, where the mining industry is absolutely counter-cyclical to the rest of the world.
Yeah, and just one point then, as a lender, does that mean that this more positive environment for mining and mining companies, does that make your role as a lender easier perhaps to find companies that will qualify for finance, or it makes the controls slightly easier for you to handle in terms of allocating capital?
It does. It does and it doesn't. And let me just unpack that quite quickly. It depends who you are as a mining company and your profile. If you're in production, if you're an AngloGold Ashanti and you are highly cash generative, chances are you wouldn't need to access a credit facility. And that goes for all mining companies that are particularly in the gold space. But if you're a developing company that's in the process of completing construction work on a project, chances are you'll need credit support to complete your project. So I think in the final analysis, commercial banks are very conservative in their thinking. And there are many banks out there that become extremely, call it aggressive in terms of lending, particularly in a bull market. And then as soon as the mining industry kind of transitions into a bear market, then those banks, commercial banks, we see them pulling out. What we prefer to do is we prefer to look at where the company is on the cost curve. And first quartile, second quartile companies, in our view, are companies that will survive whatever pressures we see in the market in terms of price. But those companies that are high on the cost curve are companies that will intermittently switch into care and maintenance and then back into production.
Okay, thanks, Nivaash. Yeah, let's come back into the companies and the sort of general performance of them in a bit. John, could I bring you in now and just get your take on commodity prices in general, this bullish market period? Have you had any conversations with investors and funds or people around, is this going to be another super cycle period?
Well, we have been very busy, that's for sure. Unusually busy, and we've been getting calls from the sorts of investors that we haven't heard from for many years. So there's no doubt there's a lot of eyes on the mining sector right now. People are looking at the seismic changes that are going on in the world. They are conscious that transport is being electrified. We're not just talking about trains, but clearly electric vehicles for everyday driving. I think quite soon we'll see delivery vans also going electric, and that'll be taken up very fast, I think, by the millions of Amazon drivers as soon as they realize the benefits of that, and as soon as the range on those vans becomes sufficient for what they want to do. They clearly need to feel comfortable that they're going to get enough range for their deliveries, and then they're going to realize the benefits of that electricity is much cheaper than gasoline or diesel. But clearly there's so much going on in the world right now. It's interesting that the lockdowns that we're in, and it feels like we're in a third lockdown in the UK at the moment. And yes, I think there probably will be a third wave of the coronavirus with different variants creating that third wave. We're possibly even beginning to see a third wave, or so we say a second wave in China. But we'll see. They're much more careful about the news that comes out of China than they were this time last year, when they really started to lock down the news flow coming out of Wuhan. But what I think we're going to see is the lockdowns will delay the general economic recovery, and that those lockdowns are clearly devastating for the services sector, but manufacturing continues anyway. Now, there are some issues in the manufacturing sector. There are problems with semiconductor supply. That's more to do with the fact that automotive companies didn't think that they were very cautious. In fact, they were overly cautious on what they'd be making at this point in time. We see logistics issues to do with containers, and the cost of moving a container from China to the West has gone up by 6 to 8 times, but that is now coming off a bit. So containerization has got expensive. But what we're going to see is there's huge stimulus being put into the market. The Americans are looking to put 1.9 trillion in, and a certain amount of that is in helicopter money. They literally hand that to investors, to the people, the consumers. And some describe that as really almost a stimulus for China rather than America. But there is also, going with that, there's going to be a sort of buy USA campaign from the Biden camp. So it's interesting how it will play out. I think stimulus will also be needed to help consumers to soak up the large numbers of cars and presumably electric vehicles that are going to be produced over the next few years. Again, that won't be quite helicopter money. That'll be in subsidy form. And we're already seeing a certain amount of this in China with their dual circulation policy, where they are using subsidies to help people buy domestic appliances in certain provinces. They're trialing that at the moment. They're helping with liquidity, although they just hit the brakes slightly on the liquidity. But also they're offering vouchers and certain incentives to keep Chinese people at home, particularly over the Chinese New Year period, where they all love to travel and go back to their families in the villages. So they're offering meal vouchers and subsidized tickets to local attractions and things like that to keep people at home. And I think that also goes with that works with their policy of moving the population from the subsistence economy in the villages to the new economy in the cities. So I think, yes, there's loads going on, but my key message here is that I think, what the stimulus is there to help the manufacturers keep going, to keep the demand going. Sure, there's going to be a slowdown, but it's devastating for services, but not so much from a metals perspective.
Yeah, lots going on. That's a great view of everything, though. Thanks, John. Just want to pick out what on the supply bottleneck side of things. You mentioned, semiconductors impacting automotive. That's having a big impact on some of these projections of the automotive industry, which is already going through a massive transition anyway in terms of switching from ICE to cleaner, hybrid or electric vehicles. Do you see these supply bottlenecks increasing as demand continues or rises for the metals that we talk about here? And do you see those supply bottlenecks really having a slowdown effect?
They can have a slowdown effect. In fact, we talked about this in March last year, just ahead of when the market collapsed, because there was a shortage of LEDs, and they are critical in so many components in the automotive industry, in the industry for construction machinery, and that's where we got the story from. And we realized that because China wasn't able to get LEDs out of certain factories in China because the logistics chain had frozen, because Wuhan, remember, is a sort of crossroads within China. And that caused factories all over the world to slow down and actually stop in many cases. That was before the coronavirus even really got going as something over here in the UK. I won't say that it hadn't got to us, because it had got to us, but we just didn't really know it at that point in time. So yes, it is something to watch, but I think we're much better able to manage it now. I don't think many manufacturers are going to stop in the next lockdown. I think lockdowns have changed in their form, and I think as such, metals are going to carry on being consumed and sold to consumers. It's just that they're not sold through shops anymore. So much is sold online.
Yep, certainly. Okay, coming to the equities points, Charl, that you raised. It sounds like there's a lot of liquidity out there looking for a home. And mining's got this opportunity now. What are the attractive points around mining that are bringing these new investor inquiries and conversations going that you're having at the moment? Is it a case of mining's good performance, or is it more a case of underperformance of other sectors, perhaps, or a bit of both?
So, if I'm thinking back to a year ago, maybe a little bit longer, I remember showing our clients a valuation chart on whichever multiple you used, but and it's sort of a peak level multiple, or the most expensive, most cheapest level, and then where we were at that given point. And for mining and energy, we were below the average of this range. And every other sector, we were well above that range if we were not at the top of that valuation range. So valuations in the mining space have been attractive for a long period of time. And there's reasons for it. The main reason, well, there's lots of reasons. One of the main reasons, I think, is the fact that companies have unfortunately destroyed value pre-2011, if I can draw a line in the sand like that. There was this chase of growing your asset base because China's demand was growing, and we got billions and billions of dollars invested in projects that maybe shouldn't have been invested in. There was M&A activity taking place that maybe shouldn't have taken place. It's all behind us, so we can't debate that too much. But the majority of our investors, and I'm thinking of the size of our fund then relative to now, were all very excited about this growth profile that these mining companies had, right? Earnings growth profile or volume growth profile that they had. And then again, 2011 or thereabout, world seems to be slowing down. China seems to be slowing down, and all of a sudden you are sitting with suboptimal projects, and you're sitting with balance sheets that's all of a sudden becoming bigger and bigger because the companies can't cover its capital, or it's not making money on projects, whatever the case might be. And unfortunately, that value destruction that took place over that period of time is what most of the investors here in the United States remember. And so when we talk to them and we say to them, look what's happened since then, you've had a deleveraging of an incredible amount. You're most probably going to sit with a lot of the large companies will have cash on their balance sheet in the near future if they're not there at the moment already, at least with iron ore at $160 and copper at $360. So you're going to have cash on the balance sheet. The number one question that we get asked is, are they going to destroy value again? And, I've had many conversations with CEOs and CFOs and saying to them, you have to change your approach. And, there's this new, it's now a little bit older, it's not new anymore, but CEOs and CFOs talking about, it's not about size, it's about profitability. And although we've been talking about that for some time now, my clients, my asset allocators have not heard that yet, or haven't heard it enough yet. They got burned in the previous let's be big cycle. And so we are actively communicating this profitability feature, deleveraging that's taking place, and then the yield that I spoke about before. And when you end up at the end of that conversation, people say, okay, well, that's great. I understand now that the companies have changed their approach to managing themselves, managing their financial stuff about it. But now let's look at global growth. And then you had, COVID hitting the world. And then you had, before that, you had China, the US in a trade war. So you had a lot of macro things. So it seems to be, for me, when I have these conversations, it's either on the demand side there's a question, or there's on a supply side the question, or there's a company specific event that's the issue. And if you think of asset allocators for a second, the big pension funds and things over here, hard assets or real assets is maybe 2% of the entire portfolio. So for them really to spend a lot of time on it and take that asset allocation risk on a 2% portfolio is just not there for them. They spend their time on other stuff. So we, and I collectively, I mean everybody in the space, have got a big job to do in explaining where and how we are going to create value.
Yep, certainly. So very well, good to get that point of view. with that then, what are you asking of your portfolio companies and the companies you speak to? You touched on it a little bit around asking them to deleverage, focus on profitability. Does that mean growth is off the table for a little bit, or is it very much depending on the company specific, I suppose?
I think it's company specific. I mean, there's the way I think about it very simplistically, and I think the way what I'm going to call the traditional commodities, right? The base and industrial stuff, the non-green stuff. For those big companies that's within that does not necessarily have the volume growth, you need to give them the thing that makes them attractive is the financial returns. That's what it has to be. We talked about First Quantum before. The things that is going to make First Quantum attractive is deleveraging, and then it's a question for them, for First Quantum, whether to do capital return or it's going to be a growth story. But I think if you talk about the new metals, the green metals, the smart metals, the strategic metals, whatever you call it, the question there becomes much greater, and it's much more of a traditional world in where we're going to have growth of the underlying commodity, whatever they produce. The funding of that is obviously going to be critical. And there's going to be things like location, geographical location for companies like that that's going to become important. So it's not a blanket approach when I communicate to people. I literally communicate to people based on who they are, where they are, and how I see they're going to be able to create value.
Yep. And just to cap it off on this point, do you see the value more within the junior tier after a good performance last year, or do you think the mid-tier kind of miners are still presenting good value for slightly less risk?
You know, I don't look at things large cap, small cap, mid cap. I look at companies globally, company by company specific. I look at large, small, mid cap, whichever way you want to break it down from a liquidity point of view. How much do I want to own? I don't necessarily look at it from that point of view. The exception to this all is maybe in the gold space where I would break it down a little bit differently, in that I see that there's a trend in the gold space of more mid caps merging, more small caps merging with each other because of geographical benefits and things like that. That's maybe the only place where I really look at it like that still, but otherwise it's pretty much liquidity questions for me.
Yep, certainly. Okay, very good. John, could I come to you and talk about, the London view on some of the points touched there around this focus on mining equities? What the investor base that you talk to and your investor clients, what are they particularly interested in at the moment in mining companies? And what are some of the questions or the concerns they have? Maybe some of these generalist attention coming back to the sector. What are they concerned about?
Well, investors come in all sorts of shapes and sizes, and that's what's always wonderful about being able to talk to everybody, because no two are the same. I mean, there are investors that are just looking for pure growth. They're looking for companies at the exploration stage. We've seen a lot more of that because the majors are looking down in that area now. We're seeing even private companies with license packages in Zambia, for example. I know of one, it's a company that set up, I think less than a year ago. It's already got two joint venture type agreements in place with two different majors. And it's, even though it's a private company, it's beginning to act like a company in that like a listed company in that it's announcing this stuff because it's quite good news. And we're starting to see that. We're seeing it across the board. I mean, ARC Minerals in discussions with Anglo American, for example, again on copper projects in Zambia. So there's a lot of that going on. Other investors, quite rightly, are looking for either projects that are very close to production or actually in production. So we've been very busy helping companies restructuring, and as Charl mentioned, leveraging their balance sheets, getting rid of these convertible note instruments, equalizing all those sorts of all that debt, turning it all into equity, and then giving the company a new lease of life where it is unhindered by all that debt and able to grow again. So that's great where we're able to do that. and then often there's a little bit of equity added, and off the company goes. Particularly now that those companies have been beaten up by low prices. They've had to reduce their costs in order to match that environment. But now that price levels have gone up, now that copper prices have effectively doubled, margins are so much higher that, okay, you could say, well, the deleveraging exercise maybe wasn't required, but it puts the company in such a good place now that growth is going to follow, so long as the resource is there. And I can think of a number of cases to talk about. Rambler Metals and Mining in Canada would be one, for example. First Quantum, of course, is another one that has been hampered by debt in investors' minds and has been mentioned already. And there's quite a few. I mean, we saw the majors got into trouble with huge amounts of debt a few years ago. We saw Glencore collapse and then restructure its debt. Had all these revolving credit facilities. Now, if you look at buying Glencore, it's on a PE of 12 times for 2020 for 2021. I mean, it's looking like a very respectable stock again. Same with Anglo American on a PE of 9. So these stocks are not looking overly expensive in the market. They don't necessarily offer the growth. Well, they certainly don't offer the growth that we see down in the junior part of the sector. And the great thing is about these higher metals prices is that it does give these companies the ability to accelerate what they're doing and bring these projects forwards. And I think there's quite a lot more money into the funds that are looking to be the last brick in the wall, looking to finance those project developments. So we're quite busy making introductions on that level, particularly in the battery space, and that's where there's a lot of new focus. I'm not quite sure how the banks are going to get their heads around financing graphite and shall we say non-LME traded metals. Not sure we can't call graphite a metal as such, but it's very important within the battery materials chain. Lithium, as in spodumene, okay, it's all going into China at the moment, but sooner or later the Europeans are going to start processing lithium, probably using a hydrometallurgical process. So we expect the metals industry to become more global. It's going to become less focused on China, and it has to become better spread out around the world, because very big automotive companies in Europe and the US cannot be dependent on single sources of supply, as in just coming out of China. And at the moment, something like over 90% of the world's graphite and 100% of the world's lithium is coming out, processed lithium is coming out of China, and that simply can't continue. So you can't blame the Chinese for wanting to get it to grab the resources. They're out of 179 mega and gigafactories in the world, and they're all growing and expanding right now. 130 of those are in China. So China has a bigger reason to put its foot on these resources than anyone else at the moment. And being well organized as the Chinese are, they're continuing to do it. So we see projects such as Kodal Minerals Bougouni project in Mali already being examined by the Chinese in great detail. So we'll see what happens there. But we think the Chinese will carry on coming out of China for these specific battery minerals, even though the rest of Chinese development funding is pulling back a little bit.
Excellent. Let's move on to a couple of Africa-specific topics, just to frame this around what would have been our Cape Town event. I just wanted to get the panel's view on, Africa's sort of growth story this century has been sort of documented around, everything from the macroeconomic setup, the population growth, etc. But where does mining fit within that? Is Africa still a great untapped resource for exploration potential? Are we seeing West Africa, come into its own in terms of realizing that potential with some of the mining projects that are going on there? And who holds the competitive edge on the continent as well? Is it a case of Australians, Canadians coming in and really doing the work, or can South African miners claw back some of that market share? Just want to get a bit of commentary going around some of those themes. Nivaash, do you want to start us off as you're down in South Africa yourself?
Sure. No, thanks, Adam. So I think let me start off by saying that the South African mining industry, although it's in very poor shape currently, with a looming electricity crisis and some level of regulatory uncertainty, it still remains the biggest mining industry on the African continent. We've only recently lost our position as the largest African gold producing country to Ghana. So we're now number 2, maybe number 3, but Ghana is now officially the largest gold producer on the continent. And if I look at how the continent has evolved from a mining perspective in the last decade, the mineralization and geological formations are incredibly attractive for miners, for explorers. The West African region itself is endowed with a very high grade gold belt and relatively underexplored. And miners are piling into West Africa, specifically the Ashanti and Birimian gold belts. And we see a lot of activity in that region. By contrast, South African mines have become incredibly difficult from a, call it infrastructure and logistics point of view. Our mines are deep, our mines are complex, and the amount of services required to support deep level underground mining is just incredibly expensive and inefficient. The oddity, however, is that South African miners are not as confident about the rest of the continent as the Australians are. The Australians are much more bold and courageous from a mining sector point of view and have been exploring Central, West, and East Africa for the last 15 years. So I would say, other than companies such as Goldfields, AngloGold Ashanti, and potentially Sibanye, Stillwater, the rest of the mining industry on the continent are essentially investments out of Australia, Canada, and Europe.
Thanks, Nivaash. Interesting points there around South Africa. Charl, does VanEck have a view with the prospects of African-based mining projects and assets? Obviously you look globally, but is there a stronger sentiment for some of these gold projects in West Africa, for instance, as are investors starting to believe that is a good location versus, say, safe haven jurisdictions like Australia?
So just from a VanEck point of view, we've been in Africa for since the late 60s, early 70s. We actually used to have an office in South Africa, so we've been involved in the continent for a long time, and we think the continent has a very important role to play to this conversation we're having, right? So to answer your question quickly, we still invested in a lot of the Southern African and East African and West African projects, whether it's mining or agriculture. We're all over the continent in a number of different things. So I think the other points that I sort of wanted to bring up to you is, as a South African that sits over here in the US, I get extremely frustrated by the fact that the rest of Africa is so managed or by Australians / Canadians. I think the South African professionals have an incredible advantage above a lot of other people, above the Canadians and the Australians, just from a location point of view, but from a whole range of other reasons as well, to be equally as successful, if not more successful on the continent. And You know, I've for the last 2 decades, I've always wondered why South Africans just not more involved in the continent than what one would expect, right? That's what you would expect them to be. I will also tell you that as an American investor, typically we are more comfortable with things in our time zone. So typically we're more, you know, Latin America, we understand it better because it's our time zone. You know, there's a cultures mix in that point of view, where if you typically would be in Europe, you'd be much more comfortable with Africa. That's just a time zone given fact. There's nothing we can do about that. I think from another point of view, I think John did bring this up a little bit earlier, and I think it's important to mention again is just this conversation about location and the production location. I think that I don't think I know this. A lot of people don't want to be tied to pure Chinese supply, right? We're looking at companies in Europe, companies in the US now, specifically with the green metals context, that can supply in our time zone, not only because we don't want Chinese control of it, but also because we don't want the logistics / COVID issues to have an impact on supply chains or production facilities, right? And I think John said this earlier, future lockdowns is going to look significantly different to the ones we had in 2020. I don't think the economy like we had in the US, where there's 0 cars being manufactured, I don't think we're going to go back there. And so when I talk to the steel industry and I talk to the VWs and all these people and the people making graphite, there's this clear conversation. We need to be close to people. And I think from an African point of view, that's one of your biggest challenges. You don't have the infrastructure to get things out, right? Just think of Zambia, think of the Democratic Republic of Congo. It always got to go back down to Durban. And then that brings me to another point, just the ESG part of it, right? In the world of green metals, ESG is talked about a lot, not only because you're making a green product, theoretically, but how's that product being produced? And, I had a number of conversations with OEM manufacturers over the last week or two, and they all, surprise, surprise, are very concerned about cobalt. And they're all trying to work cobalt out of the system. And the reason why is because they question the production standards of cobalt within the DRC. And I think that's the type of stuff that Africa needs to deal with, is how do we get around the perceived, and I said perceived, ESG concerns that non-African investors might have. And just one very easy solution would be, we all know what Anglo American has done and First Quantum has done and Anglo Gold's done regarding hospitals, regarding schools, regarding communities, regarding job creations, et cetera, et cetera, et cetera. I mean, the list is long. But guess what? None of these companies talk about it. And so go back to an earlier question you asked me is, what do I talk to people about? I talk to them a lot about the valuation opportunity they have. And then I talk to them in a most probably equal amount of times about their lack of properly communicating ESG metrics, ESG opportunities, and things that they do specifically to those people within Africa.
Yeah, excellent. That ties in the ESG element that I wanted to conclude on. But John, could I bring you in for some of the Africa-based trends and maybe some commentary that you could add to what's been covered there?
Yeah, just listening to the comments, it's interesting because as a young trainee in the mining industry, I first went to South Africa and I thought, hey, this is good. This is very, very Western style, very modern, but with an African workforce and all the things that went with that. And then some years after that, I ventured into the rest of Africa, and I got a bit of a shock when I discovered that the roads didn't really work. There wasn't much in the way of electricity, and that there wasn't the bureaucracy or should we say, there wasn't the infrastructure available that takes for granted in South Africa and still works in many respects, although it may not work so well going forwards. But I find it interesting, this comparison between South Africans and Australians. And remember, many South African mining engineers have gone to Australia now, so it's all mixed up. But I feel that The Australian market has been brilliant as an incubator market. It's funded lots of explorers. They're people who are very dedicated and brilliant at what they do. But I always think that Australians going into Africa are a bit like a blind man heading into a foreign bar for a drink. They've figured out how to get to the bar. They know there's a drink there, but they just don't quite know how to get at it. And frankly, that's where you bring the South Africans in, because the South Africans are really, really good at getting stuff done. They understand Africa. They're very sensitive to the way that you need to be in Africa. They're really conscious of local sensitivities. And that's fantastic, because not many nationalities in the world are actually that sensitive to the sensibilities of other nations' needs. And in Africa, that's just so important. So what you often see is a really good team is a bunch of Australian geologists working with another bunch of South African mining engineers to actually get things built and get the job done. And I think that combination of skills can work really, really well. And I think we are seeing the fruits of that in many parts of Africa. And Africa, I think, is the solution. I think this is why we're seeing companies that have been frustrated by Zambia in the past going back in there. Even Anglo American, which pulled out of Zambia in the late 90s, early 2000s, is looking at going back in, because that's where the copper is. And it's a country where you can get things done. And you often see this in Africa. Yes, everybody gets frustrated with the politicians and the lack of local services and infrastructure. But actually, you can get stuff done. You can, if you talk to the local guys in the right way, things will happen. They will be really helpful. They do want the jobs. They do want the taxes. They just want it to be done in a very fair way. I mean, companies like Glencore that have effectively been kicked out of Zambia are being kicked out because they didn't play fair. If you play fair with these African guys, they will almost always play fair with you. And if you talk to the specialist investment funds that invest in Africa, they say that often you don't need a big legal contract. You might, if you're doing business in the States, you have to have a huge legal contract, and it doesn't necessarily help you at the end of the day. If you're in Africa, you can still do stuff on a handshake, and they will still honor these agreements. And you just have to be savvy and careful about what you do. So I still see I see Africa as the place that is going to supply the metals that the West the West and the East now are going to need to electrify their economies, not just the electric vehicles, but the wind farms, the solar farms, all the grid infrastructure that's going to be required. And I think if it wasn't for these pragmatic Africans, we wouldn't be able to find that.
Yep, excellent point. And that leads me on to something I just want to touch on very quickly to take us to time. If I could just get a quick 1 minute comment from each of you, perhaps. Within this transition metals, technology metals complex, is the revolution to a greener, cleaner society coming as quickly as some of the EV and renewables industry practitioners say it is? And are the policies such as London or UK scrapping ICE vehicles by 2030, are these kind of policies realistic? Is the revolution going to come that quick enough? And are the metals there being processed in order to enable that to come on to happen on target? Anyone want to jump in?
I'll go first and I'll be quick.
Yeah, please.
I think there's a growing disparity between supply timelines and the expectation of rolling out a new product on the auto manufacturing side, just to use an example. I mean, we all know to develop a mine takes 5, 6, 7, 10 years, whatever the number would be, right? To develop a new anode is 12 months. I had a conversation with one of the big global auto manufacturers. If they roll out their perceived EV transition over the next 5 years, they will be 30% of the global graphite market as it is today. That's not feasible, right? So I think there's a big supply is not going to keep up with what demand's demand's projected to be.
Nivaash, are you seeing more activity or more interest in the technology metal miners at all?
Absolutely. So before lockdown, there was a huge call it, I'm trying to think of the word, obsession about graphite, particularly graphite. And Nedbank went around doing some technical research on 3 commodities that we picked, graphite, cobalt, and lithium, as key commodities that we would like to understand and we would like to bank at some suitable time in future. And then lockdown happened. And with the reliance on technology, laptops, devices, iPads, and so on, we now see a further surge in demand for these, call it exotic metals. And it's been growing ever since. However, I have a very different perspective on it. I think Africa will supply the commodities, but there's no market for EVs here. And I don't think there will be for at least the next decade. I still think the internal combustion engine has not yet saturated itself in this market, and it will be around for a good few years to come. But Africa will supply those exotic commodities that I've mentioned. Whether a commercial bank would fund them, I know John mentioned this earlier, and then I had connectivity issues, so I didn't get a chance to hear the end of that conversation. We recognize that there's a hype around these metals, and we're very concerned that this is a massive bubble that's about to burst. So again, I think it depends whose lens you look through. If you're an equity investor, I feel very sorry for you on the basis that this bubble, if it bursts, it's going to happen so instantaneously. It could have very severe consequences for equity investors. And if you're a debt provider, we largely mitigate our risk through contracts, through offtakes, through various instruments and credit enhancement techniques. So we're looking forward to funding exotic commodities, but we have to pick the right one at the right time.
Certainly. Okay, John, do you want to wrap us up? Is the EV revolution coming as quick as the headlines suggest and everyone thinks, or are the metal supply challenges going to slow it all down?
Well, weirdly enough, one of the surprises that we've seen over the last year is that EV sales barely skipped a beat with the lockdown situation. So if anything, the EV revolution seems to be coming at us faster than all those crazy charts were suggesting. There's no lack of desire by, or shall we say, pull by policymakers who are accelerating the clean air initiatives in cities like London and elsewhere in the world. And again, that's going to be driven because there are going to be larger numbers of people with lung issues as a result of COVID-19. So there is this thing called long COVID. It gives people ME type symptoms where they're tired for longer, but there are going to be quite a lot of people with scarring of the lungs and scarring on the heart as well. And okay, I don't work in the healthcare team, but I talk to these guys and they tell me that, these are going to be ongoing issues and we're going to have to clean up the air in our cities. We now see that they want us to stop burning wood and coal. I think probably even in the countryside soon as well. So we have to be conscious of that. The electricity is going to have to come from somewhere. And as has already been said, these exotic materials, rare earths, are going to become more important for offshore wind farms and stuff like that. But I do think one of the things that's going to slow it all down slightly is the speed of stimulus spending. The Chinese are brilliant at spending money very fast. They had lots of projects all ready to go and loads of stuff already planned. So it's very easy for them to start pushing that cash into their economy and rev those factories up straight away. In the US, it's going to take longer. In the UK, we've had a few projects up ready to go, HS2 and the new line from Oxford to Cambridge. We're going to effectively reverse a certain amount of the destruction of the rail network that Dr. Beeching put in place about 60, 70 years ago. So we'll return to the heydays of hopefully the empire. But we're going to be held back by logistics. As I said earlier, container prices have gone up a lot. There are going to be a few delays to mine expansions and things like that. And I think we're going to end up in a deficit situation that could cause a few problems. That inevitably will provide a little bit of a break on stuff. We're already seeing that automotive manufacturers have had to slow down because of the lack of semiconductor chips. Some of that's because of so many people have been working from home. There have been a lot of big sales of gaming consoles and laptops and those sorts of things. Yeah. So the world balances itself a bit, but I think in the meantime, as larger numbers of EVs are being charged up overnight, policymakers are going to have to figure out how to create better support for the national grid. Every country has a grid these days, and South Africa knows very painfully what rolling blackouts feel like. I think we're going to get more of that here in the UK, and then I think we'll see it in the States, where they've been big buyers of electric vehicles. So that in itself might provide a little bit of a break on things. But even so, I still think our advice to investors is to buy the dips. But I still think we're going to see good price appreciation in copper, which I think is going to over $10,000 a ton. I think nickel's probably going over $20,000 a ton as well. I think there's going to be ongoing buying of ferrochrome, ferrovanadium, those sorts of things. Those metals are heading over to China in ever larger quantities. So I think the mining sector is in quite a good place.
Excellent. Well, gentlemen, that's taken us to the amount of time we've got allotted. We could go on a number of topics, but just thank you very much for giving the time to provide this feedback to our audiences. And that's been a great start for One-to-One Mining Investment Africa Online. So thank you very much.